Now, Gerry Fowler is the Managing Director of European Equity Strategy at UBS, and he joins us now. We want you to get in here. I point out that about 2 months ago, you thought the AI trade may be on the verge of a bubble. So what are your thoughts now, especially given that AI-related stocks are now, we have to say, at only a few percentage points, some of them, after hitting all-time highs?
Yeah, it's really an incredible run, but there are two things driving it. One is the fundamental story, which is incredible and drives consistent earnings upgrades for many of the companies in the AI capex supply chain around the world. But the other is also the speculative mania that is associated with that. Fueled by excess liquidity that still exists in the market. So you can see that in levered ETFs, which have become very popular, even down to single stocks. You can see it on 20% of the S&P 500 stocks that now have call options that are more expensive than put options. That's rather rare, but basically suggests that investors are suggesting there's a lot of upside. And we can see margin debt exploding as well, just to name a few of the things that make us worry a little bit about the mania and the volatility that creates.
The worry is largely warranted, and yet some analysts believe this is still, in fact, healthy for the tech market itself, right? A bit of cleansing and it will propel higher. What's your take?
Yeah, correct. I mean, with a lot of volatility, it does deter people using excess leverage. It squeezes out some of that leverage. We saw that a couple of weeks ago. We've seen that in the last few months, really. I mean, it was only about a month ago that the Kospi, which has a couple of the big memory makers in it, fell 10% each of 2 days and then rallied back 10% on the third day, really fueled by some of the forced trading that happens because of levered ETFs and other technicalities within the market structure. So you can squeeze out some of that leverage and potentially create better opportunities for those that truly believe the fundamental story. The fundamental story is very much driven by constant upgrades by those hyperscalers of what they intend to spend on building data centers, their capex estimates. So long as those capex estimates continue to not just show strong growth, but actually that the growth is being revised to ever faster numbers, then the fundamentals will support ongoing buy the dip activity from investors. But we are potentially getting to the point where there are some risks to the ability of those hyperscalers to continue accelerating expectations of their capex spending.
I think that's what's top of mind for so many investors, right? They're wondering, do you buy the dip here? Is there still upside to be had? Is it a buying opportunity when you see days like this?
Yeah, we do. I mean, after one day, not necessarily, because one day can clean out some of the one-day leverage. You get some levered ETF trading and some call options and some margin debt that gets called. But that can cascade, as we saw in March, into more aggressive quantitative selling from other investors. So there are CTA investors who will sell into negative momentum. There are risk control investors who will sell if volatility spikes. So there may be ongoing flow, again, completely non-fundamentally driven flow that can exacerbate moves beyond just the first day into several days. So it gets a little bit tricky to actually call a specific buy the dip moment. But at the moment, these themes, these AI themes, whether it's memory or other parts, which is obviously being most impacted today, and other parts of the AI capex spending beneficiary supply chain, there is still positive earnings revisions. So even though they are expensive and crowded, which creates these vulnerabilities for volatility and reversals, the fundamentals are still in place for them to rebound and grow. And we can talk about the fundamentals and what might cause an end to that. But certainly at the moment, the volatility we're seeing is very much a feature of market structure relating to the mania that we're in and the excess liquidity that the US policy has created.
And Gerry, I don't have a lot of time left, but I do want to ask you, because you said in January that this is why the next phase of AI-driven returns could be less about the often expensive and crowded beneficiaries of AI, I'm quoting you here, AI spending, and more about the often cheaper and less well-owned companies. I mean, a lot of that has to do with productivity. What do you think?
Yeah, absolutely. So we have been expecting that productivity will start to come through in various areas, particularly those companies with lots of data, lots of processes, lots of customers. So we've been thinking things like banks, food retailers, transportation companies. What's really doing very well today, particularly with the volatility, are quite defensive companies, but in particular healthcare and the GLP-1 theme, which has been really poorly performing for a while. But we're starting to see both more investor interest, and for good reason. It's because those companies have been very weak on their fundamentals, but are really starting to improve. So a lot of investors want to start to trim their AI capex related exposure, transition into other things, which includes things sensitive to the US acceleration and healthcare. And that's what's causing this volatility, is a little bit of rotation to other things that aren't just the AI thing.
Right, gotcha. Gerry Fowler for us. Thanks so much. Appreciate it.